We're going to bring you now to Davos, Switzerland, where the World Economic Forum is underway. My colleague Erik Schatzker has grabbed the Bank of America's CEO, Brian Moynihan. Erik?
Margaret, thanks so much. Brian Moynihan is here with me in Davos. Brian, you just got back to the WEF, anyway, from a meeting of your fellow bankers and Tim Geithner, the Treasury Secretary, who himself just rolled into town. How did it go?
Well, I think we're all here talking about the same things we talked about last year, but in much different context. You're a year forward, and so discussions about how we continue to work as an industry, and it was an industry discussion, to move forward and continue to heal the economy. That's what responsibility we have as a financial institution. And on top of that, work with the regulators to make sure this never happens again. And that's what the dialogue is about.
How would you characterize the exchange? Friendly, positive, constructive? What did you guys get out of it?
Well, it was a question and answer session with Tim. It's always friendly and positive in terms of his thoughts about what was going on. Our industry is here to continue to talk and have a dialogue about how we can continue to move forward and put behind us the financial crisis and recession, and we still have work to do.
What kind of questions were you guys asking him? What kinds of questions was he asking you?
Well, without getting into the stuff, because it's, as you know, it's the rules are that you don't talk about, but the broad strokes are about the regulatory environment and mainly how do we make sure that we have, for us international-based institutions, which a lot of the institutions are, how do we have comity among all the institutions, so that all the institutions and all the jurisdictions, so that we can operate around the world, provide capital to our clients, and be able to do it in a way that's safe and sound for all the jurisdictions. And that's that making sure we keep making progress on that is a key initiative for us.
You know, Brian, that reminds me of a conversation that we had right here in Davos last year during the World Economic Forum, when you took a leadership position for the banking industry, making the case for, and in some cases pleading for, sensible, sound regulation and coordination among global regulators. We're a year on. Did you get it?
I think, you know, through the, if you think about the capital rules, the Basel rules, I think we have a uniform system. There's a lot of progress made. It's always going to be subject to the realities of different economies and different sized economies and different size of institutions relative to the economy. In the United States, the financial institutions are big, but they actually have less than half the financial assets. So it's a different task for the United States regulators versus other economies where the financial institutions own a lot of the economy. And so I think that's always going to be different. But I think a year later, we've gotten good progress on capital rules, good certainty around that. The capital markets understand it. We're moving forward. There's still work to do. On the Dodd-Frank and other stuff, there's still work to do. But I think the outlines of the regulation in the United States and around the world are there. And I think the backbone's relatively straightforward, relatively understood around the world, and relatively the same. There's still elements that got to be worked out.
Some of your fellow bank CEOs have been saying here at Davos that the politicians don't get the role that the bank industry plays in helping the economy back on its feet. Do you share that view?
Well, I think everybody understands that the economy and the banks are highly correlated to each other. The success of the banking institutions is due to the success in the economy, and the success of the economy is due to the fact that banks provide capital, especially for the inefficient parts of the capital structure. In other words, small, medium-sized businesses, consumers, places that they can't get to the market directly. Big companies get to the market and find it in the market. And so I think everybody understands that role. I think people just have a different point of view at given times, and that point of view has changed over the last 2 or 3 years as to the need to control the impact of one on the other. And I think the goal of the regulatory and political policymakers is to make sure that the mistakes made by institutions don't impact the broader economy. And that's a very valid and absolutely right way to think about it. And then the goal of financial institutions is to help drive growth and help take the risks we're supposed to take. And we all took risks we shouldn't have taken. We probably had regulation that didn't work in the hindsight, but I think we've learned a lot over the last couple of years about that.
Yours is a moderate view, but does it make sense for some of these fellow bankers to be adopting an aggressive stance among a crowd like this when, as you and I well know, there are lots of people, many powerful people, in fact, who don't trust the banking industry yet? Well,
I think that our job, my job, and my colleagues that run the major institutions is to help drive the economy, help do it. And it's not that it's a philosophical question. We're helping the economy. We're helping our clients who drive the economy. We're helping them do what they need to do, whether it's you as an individual or a company. And so without getting into what somebody said, because I only recently arrived and I haven't caught up to everything, but said, I think that all the heads of institutions feel that their job is to make sure we're driving forward for our customers, and sometimes we're representing our customers' point of view about things, and sometimes we're representing impacts that we'll have on our customers. And so that may sound like we're pushing back, but I think it's more in the context we know what our job is: serve our customers, drive the economy, and sometimes that has a reasonable framework of debate. But that's what this is for.
There are tensions, though. You probably heard about the exchange earlier today between the French President Nicolas Sarkozy and your friend and colleague Jamie Dimon from J.P. Morgan. Him arguing that the G20 should focus on jobs and growth, a view you may share, and Mr. Sarkozy saying, look, the G20 is going to focus on moral issues. Is that really a sensible way to get the dialogue going as we look forward into 2011?
I can't reflect on that. I wasn't there, so I missed the dialogue. But let me tell you that it is important that we focus on jobs and growth, and that we focus on getting the rules right and striking the balances. Because at the end of the day, a lot of the fundamental fissures in the economy and stuff are healed. So we had a jobs number today, which is not quite what people wanted, but it's a lot better than it was 12, 18 months ago. We just got to keep pushing forward, especially in a large economies that need to grow to help the world grow.
You're probably aware that Standard & Poor's downgraded Japanese credit today from AA to AA-. In your mind, is that a signal, perhaps a warning, a shot across the bow that America needs to take deficit elimination more seriously than it has up until now?
I think you've heard from the American people, and we've heard from the policymakers. It is the issues about the amount of debt and handling that debt responsibly over the next decade or so is a critical issue for our country, both at the federal level and the state level. No one debates that. How you do it, the choices you make, balancing near-term issues and growth versus long-term issues, those are the types of things there'll be a lot of debate about. We have points of view as a company, other people have points of view, and you would have points of view. But the key is there's no one that thinks that we cannot take very seriously the issue of our debt structure going forward. And if we don't, someone will take care of it. Things like downgrades and stuff, those are issues that we've got to avoid completely. We're a strong country. We're a great country. We have a lot of great prospects. We just have got to take care of getting our house in order over the next decade. It's something we can work through.
Difficult balance to strike clearly, as perhaps the UK is finding out. Do you think what happened with UK GDP contracting unexpectedly in the fourth quarter, that's a sign similarly that you can't take steps too aggressively?
I'm not sure I'd read any quarterly data point, frankly, because you
and Larry Summers both.
I think you think about, we've been in business 230 years as a company. There'll be a quarter or two where something won't go your way, and you have to push through it. And I think, these countries have been around for a long time. The political systems have been around for a long time. I think people have to be careful of overreading a data point. You have to pay attention to it. You have to be mindful of it. But you got to be careful that these things, the depths of the recession that we went into were so deep that this is going to be a steady movement forward we're seeing, but it's going to be a long, steady movement. It's not going to happen overnight.
You talked about your company's own history. Let's spend a few minutes on Bank of America. The issue of compensation has come up here over the course of the World Economic Forum. A couple of your European counterparts have decided to use these contingent convertible bonds as part of compensation for, say, top employees. Is that something you've considered?
We didn't look at bonds. We used stock. We've always used stock heavily in our history, and we continue to do that, and we'll continue to do that this year. And stock will reflect the value of the company that we derive this year, which is what we're paying for people, and also can they sustain that value over time. And that's been so for anybody, as people get paid more, they get more and more stock in our company, and as senior people will get predominantly stock, and we'll release that after it comes out. But it's really, so I think stock's a better thing because it's what the shareholders, my job is to get the shareholders returns, and that reflects, it reflects my management team and our senior employees, our employees that get paid more money. It reflects when they get paid, the shareholders are getting paid.
Similarly, well, let's move on to a different topic, actually. As you probably know, the SEC is considering new rules for brokers, would make them fiduciaries. Does that change the business model for Merrill Lynch? You have the biggest brokerage in the world, given the legal and regulatory risk it would introduce?
Well, I think the basic principles are do what's right for your client. And we've run a fiduciary business model for a long time in our company. You think about private banking and other things. And inside the Merrill Lynch construct, there's fiduciary models and stuff. So I think it's not something that's foreign to us. And I think if it helps If it helps instill confidence, it will require more work, and that may be good work. If it helps instill confidence, it makes it clear we can do it. We've got to be careful because the numbers of the numbers of people involved in the 250,000, 300,000 registered reps out there plus, we got to make sure that they can conduct their business. But on the other hand, we've always said that issue is one which we'll adapt to when it comes out. But behind it is you got to do the right thing for your clients, and we've always done that.
All right, Brian. Good of you to join us here at the World Economic Forum once again. Brian Moynihan, the CEO of Bank of America. Margaret, back to you in New York City.